So welcome everyone. Thank you for being here. It's a really important topic today, maybe one of the most important topics we could ever talk about. There was just an article that came out today in Fortune magazine that said, it's like when you see the tsunami coming. You see the water, it's up 2 inches, but what you don't see is the tsunami not coming. You don't see the tsunami that's coming. And what the article went on to say is that studies, that they quote the study from Texas A&M Bush School of Management, they quote agricultural economists, what you don't see coming, what most people don't have any concept right now, they don't see it coming, is what's happening in the grocery stores. They're predicting milk by this fall will rise from $7 to $14. They're predicting grocery prices will rise somewhere between 50 and 100% by this winter. Grocery prices. Some people will be able to move down the food scale to processed foods. Strawberries could become a luxury item. That's what they talk about in this article. What happens when that happens? When people see that that grocery prices are up, that other prices are up, what they do? They begin to ask for more wages. If you look back in 2024, we had more strike days over wages than we had in the previous 10 years combined. 225 has been one of those years, and 226 could be even worse than that. It takes us back to what was happening in the 1970s, 80s, and 90s. So the idea today is to understand in stagflation what works and what doesn't work. Looking at the grocery store is one indication, but we're dealing with tariffs, and the full impact of tariffs is not really being felt. It won't be felt. Some of the tariffs are being eaten by the companies, but when you've got a 25 or 30 or 40% tariff, a lot of that's being passed on to the buyer and the consumer. And yet it's really not showing up. Most people don't see it greatly. We saw wholesale prices increase the most they've increased since 2022. But I don't think most people are seeing it. I'm not the only one. Fortune magazine, the studies that are being done say that most consumers have not realized what's happening. And it's going to get worse. 41% of the S&P's 500, 41% of the Standard & Poor's 500 companies' revenues come from overseas. That global trade is going to be dramatically reduced. So what works and what doesn't work? History doesn't repeat, but that it rhymes. So we can look back into the 1960s and 1970s and 1980s and 90s and see what did work and what didn't work. One of the things that is pushed in a great deal is asset allocation in inflationary times. So the idea of asset allocation is buying different assets so that when one goes down, another goes up, so that you have an offset between different asset allocations. The way you get to those correlations is through linear regression or even canonical correlation. I remember when I graduated from Oregon State with my degree in math and was on my way to Carnegie Mellon for my MBA, I was hired for a summer internship at Pacific Gas and Electric in San Francisco. And it was just at the time when companies were really beginning to discover operations research and the ability to forecast with computers. At Pacific Gas and Electric, it was important for them in their forecasting. It was a key component because if you built plants too soon and sent out bonds, you didn't get the income to pay off the bonds. If you did too little expansion, you ended up with brownouts and blackouts. So the whole concept of forecasting was crucial. And in the past, the way forecasting had been done is you took out last year's forecast, counted the number of dividers in the book, and put in the same number of dividers for this year's forecast. But that summer of 65 was something new, and I was part of that. And we were trying to do correlations. We were trying to look at everything that was correlated to electricity. And we threw in everything we could think of, anything that had anything to do with data was being thrown into the pot and correlations run. And you know what we found? 97% predictor of electrical prices in Northern California. 97%. That's almost for sure you can say this is an absolute predictor of what's going to happen. 97%. The best predictor of electrical prices in Northern California that we found via linear correlation, linear regression, was the number of prisoners on Alcatraz. Has nothing to do with electrical consumption. There was no causal effect. So when you're looking at asset allocation, taking from that example, there has to be a causal effect on what drives up one asset versus what drives up another asset. That's really inconsistent. And what we saw in 2008, 2007, 2008, we didn't see one thing go down and another go up. That's the theory behind asset allocation. What we saw is everything went down. Everything went down. I've heard asset allocation described as, wouldn't you rather be in an elevator that had 4 cables going up than 1 cable? And if you put in overweight, whether it's 4 cables or 1 cable, if you overweight the elevator, it's going to go down. Asset allocation didn't work in 2008, 2009. The question is whether it would work in an inflationary environment. I don't think so. I think asset allocation is going to be an issue. Everything's going to go down. Financial planning. And I want to give an overview. Financial planning is the idea that you can set a plan and make adjustments to it as you go forward, and it gets you to your goals. Next week, I'm going to dig deeper into what goes on with financial planning and the problems. Financial planning is based on wrong statistical assumptions. It's based on arbitrary data, and it leads to a sense of well-being when in fact it isn't. You know, I've heard it described as a plane flying from Seattle to Hawaii. You make small corrections for the wind and so on. I can say, if that in that example, if you don't have enough fuel, you're not going to get to Hawaii, no matter how many course corrections you make. Financial planning sounds wonderful, but in an environment of stagflation, will it really get you to the goals? I don't think so. We're going to talk really in detail about that next week, because financial planning has become such a part of the investment world today. So let's talk about some of the individual things, some of the individual asset classes. Stocks, for example. During 1966 to 1982, stocks reached on the Dow, which was the primary index in that period of time. The Dow reached 999.9 in 1966. Then it dropped 20% by the fall of 66. It rose again until late 1968. It was at 1,000 again. Then it dropped another 30%. And then it rose to 1,000 again. And then it dropped by 72 to 40%. And then it began to rise again and got to 1,000. Again, dropping again in 70, 78, it was dropping down. It dropped another 20%. And finally in 82, 16 years later, stocks passed the 1,000 mark. But if you compare the consumer price index in 1966 to the consumer price index in 1993, and you look at the Standard & Poor's in 1966, the Standard & Poor's took 32 years. No, I said 66. 1961 to 1993, the consumer price index rose so much, rose sixfold, it took 32 years for the Standard & Poor's to catch up. Stocks, for people that are doing passive income, for people that are doing index funds, there's a very high probability they're going to suffer through this and end up not with a 5-year recovery, not with a 3-month recovery, but with a very long, multiple decade recovery to recover. Bonds. Bonds have a maturity date, they have a coupon and a face value. They have an underlying rating, the credit quality of the bonds. The Fed, there's so much talk about the Fed lowering interest rates. The Fed has a lot of control, 99% of control over short-term rates. They can set the discount rate, they can set the Fed funds rate, the rate at which banks can borrow from the Fed, can borrow from one another. They can control that. But long-term rates are set by the market. The Fed has no control over what happens to long-term rates. That's why people talk about the 10-year Treasury, why they talk about, even less so today, about the 30-year. But a few years ago, they were talking about the 30-year as well as the 10-year. That's controlled by the market. That's controlled by what people are willing to buy and what they're willing to sell. In a normal, static environment, short-term rates are about the same, very close to what the inflation rate is. And long-term rates are about, the 10-year to the 30-year are about 3 to 3.5% over the rate of inflation. They're that high because it's a compensation for the potential inflation and holding that bond long-term. That's the idea behind the curve. But when you have inflation, the Fed may push down interest rates. We may see the Trump administration getting its way with interest rates coming down, and Wall Street getting their way with interest rates coming down. They're talking about short-term rates. What it does for long-term rates are going to depend upon inflation and stagflation. There's this whole idea that you can build a ladder, having some short-term, some medium-term bonds, having bonds stretched out in a ladder. Ladders don't work. Ladders never make it happen. If you look at bonds, bonds have a maturity, they have a credit rating, and they have a final maturity date. They have a face value, I'm trying to say. That's bonds themselves. If you're in a bond fund, there's no guarantee that the dividend's going to remain the same. There's no guarantee of a maturity date. Bond funds are at the mercy of whatever happens in the market. And usually for bond funds in a stagflation, it's not a very pleasant time. Bonds don't work. Commodities. Commodities are really interesting because commodities, what we saw in the 60s and the 70s, we saw commodity prices up, not just oil, but commodities in general. We talked at one of the previous programs about the great grain robbery when Russia sent in to buy 30% of the US production of grains. Commodities. So a lot of commodities depend upon the per capita income in a country. When per capita income is less than 4,000 per year, the people are in subsistence. They don't have the money to buy the commodities. They don't have the money to build the infrastructure. They're living on subsistence. Once income becomes greater than 20,000 per capita, much of the infrastructure has already been built. The demand for commodities begins to decrease and go away. People are spending money on other things besides commodities. It's in that $4,000 to $20,000 range that you have demand for commodities. And there are 55 countries that exist in that area. They account for 23% of the worldwide GDP. But the big issue this time that did not exist in the 1960s and 70s is that those countries coming out of COVID, coming out of government borrowing, now exist with 206% debt compared to their GDP. They're not going to be big buyers and not going to be building their infrastructure. They're not going to be commodity buyers. Commodities are probably not going to be the place to make money in a stagflation time. And I want to leave one aside, is I want to talk about gold and what happened in that period of time. That's coming later on. Alternative investments. This is getting a huge play today. Alternative investments are not correlated to anything else. Alternative investments, we saw in 2015, the beginning of a real alternative investment with a lot of mutual funds coming out with alternative investments. In fact, there were 1,345 mutual funds that came out in 2015 as alternatives. You know how many there are today? Only 341. Over 1,000 of those investments died. Zeroed out. People lost their money. We talk about private credit today. Investors are getting an 11% return on investing in private credit. It's not the return of what they're getting on their investments. The question is, will they get the return of their investment? We've seen periods of time of limited partnerships. We've seen limited times of so many things going on. Private credit, private equity. Times were good at a certain time. If we had a period of stagflation, the chances are a lot of alternative investments will go the way of those alternative investment real estate funds. Think about cell phone towers. You can invest in cell phone towers. If the satellites get going and eliminate the need for cell phone towers, what happens to those investments? You're locked in for 10 years when you make that investment. What happens if the demand goes away? Alternative investments, probably not where it's going to be. Cash. Cash will hold its value. Cash will be what it is. But like I said at the beginning of the program, we're seeing a time in which a tsunami in prices is probably coming. We're seeing a time in which where the vast majority of farm workers are undocumented. We're seeing them deported, and we're not seeing a replacement by American workers. The average farm worker who's picking strawberries is earning 18 bucks an hour. The estimates are to replace that person with an American-born citizen, you have to pay somewhere in excess of 30 bucks an hour to get them to pick strawberries. What does that do for the price of strawberries? It makes strawberries a luxury product, no longer a nice fruit to have, but a luxury product. Milk, 7 to 14 bucks. Look at beef prices. Look at what's going on. Cash, $1 is worth $1. But what a dollar will buy in 3 years versus what a dollar will buy today could be significantly less. Significantly less. Cash is not a place to be. Annuities. Tons of annuities being sold today. Annuities. You lock your money up for a period of time, usually 10 years, and you have a surrender period to take your money out before that time. Annuities have been considered. Ken Fisher says he'd rather die than sell an annuity. I'm not quite there. I think there are a very, very, very few places where an annuity works, but not in the vast majority that are being sold today. Susie Orman, Helen Olin, so many experts said that the only beneficiary of an annuity was the financial advisor who collects the commission and collects the fees. No benefit to the investors. The insurance companies are charging 2% for the insurance part of the annuity. They're dragging a quarter point or half a point through the funds that are in it. And last week I talked about mutual funds up to 3.17%. Add 2% for insurance. Add an extra quarter or half a point for the insurance company to drag through the mutual fund. And it's a terrible investment. Absolutely horrible. And a fixed annuity is going to be like holding cash. Holding cash. The value that the income will provide is going to drop by 60 or 70 or 80%. Annuities are the wrong place to be. An interesting thing happened in the 1970s. In 1933, going through the Great Depression, the idea was to make the dollar solid. They tied it to the gold. They tied it to gold. Every dollar bill was backed by an equivalent amount of gold. $32 would buy you a full ounce of gold in 1933. And by 1972, the dollar would buy you 32 ounces of gold, or $32 would buy you 1 ounce of gold. Same thing, the dollar was backed by gold and backed at a fixed rate. And what was happening as inflation was picking up in the United States in the late 60s and into the 70s, central banks from around the world were cashing in their dollars for gold. They were presenting demands to the US. And as Nixon was elected to president, he's watching Fort Knox being drained of gold. And in 1972, he untied gold. He removed gold as the backing of the US dollar. Had he not done that, Fort Knox would have been empty of gold. It would have been sitting in central banks around the world. Nixon decoupled gold from the dollar. And the price of gold shot from $32 an ounce to $800 an ounce because you had all the inflation that had been building up from 1933 to 1972, almost 40 years, in which the price of gold was fixed the price of the dollar was fixed to the price of gold. And so gold prices shot up to 800 and then began to cave back down to around 400, a more reasonable level considering the value of inflation. Gold is one of those products that's considered an inflation hedge. Gold right now is selling at a very high price. But gold is one of those things that can be used. They use it in teeth, they use it in jewelry, they can use it in other things. It has an intrinsic value. In theory, I wear suits. In theory, the suits I bought in 1986 when I got into the business, I should be able to trade the same amount of gold in 1986 for that suit as I could trade for a suit today. Not quite the same because gold varies up and down. But gold has no revenues. It has no earnings. It has no credit quality. It has no coupon. It has no maturity. Gold prices are just what people are willing to pay. It could be bid up. It could be bid down. In theory, over the long term, it probably tracks inflation. On a short-term basis, during inflationary times, during geopolitical turmoil, gold will tend to rise. But can you count on that? Probably not. It's the same with cryptocurrency, probably. Cryptocurrency has no earnings, has no revenue, has no coupon, has no fixed price, has nothing backing the coupon except for things like stable coins. They're esoteric. Will they hold up? Will they do well? Probably not. It's not the best. It's not going to be a happy time for amateur investors, probably. It wasn't a happy time for amateur investors in the 60s and 70s. It wasn't a happy time in the 30s. It's going to be a difficult time for a lot of people, a very difficult time. And most people are not really aware of it. I think the article that came out in Fortune today that said there's a tsunami coming, and most people are only looking at the 2-inch increase in the level of water right now. They don't see the tsunami coming. By the time the tsunami is here, it's going to be a really difficult time. Now is the time to prepare. Yesterday was a better time to prepare. Today is better than tomorrow. And it's going to be a stock picker's market. I've talked about this before. I talked about this a few weeks ago. There were stocks that did extremely well in that period of time. A little hamburger chain, drive-up restaurant chain, no place to sit down, cheap hamburgers, 19 cents. Company came public in 1966, and 100,000 invested in that company by the end of the 70s was worth $1 million. It had grown tenfold. While the market had gone nowhere, that stock had grown tenfold. A little radio repair shop in Colorado, realizing the potential for the transistor, converted to a electrical distribution company. 100,000 invested in that company in 1966 would have turned into $2 million by the end of the 70s. Advanced Micro Devices making random access memory chips by 1986 had grown from $10 a share to $1,700 a share. Index funds are going to trail the market, but it will be a stock picker's market. I have no assurance that's going to be true, but it's probable. If you look back, history doesn't repeat, but that it rhymes. And it was a stock picker's market in the 1960s and 70s. Probably during periods of inflation, it's going to be back to that. Anyway, with that, let me take questions or discussion. Let me ask you what your thoughts are.
Thanks, Mike. So if you do have questions, and I have a few of them queued up, if you have questions, you can either insert them into the webinar chat or into the Q&A function. You can find both of those buttons at the bottom of your Zoom window. In either case, I'll be relaying those questions to Mike. If you ask something in the webinar chat, just be aware that everyone might be able to see that if you send that question to everyone. So if you have something of private nature, send it in the Q&A just to be safe. Mike, the first question that comes in is somebody's asking for your detailed description of what stagflation is and how it is different from regular inflation.
Stagflation is inflation coupled with a recession. It's having a receding GDP falling, at the same time you have prices increasing. Usually when you have an economic time of when the economy is going south, you will usually have unemployment rising. You will have the demand for products decreasing and prices become squeezed. I had another business at one time, and I can remember somebody telling me during the recession of the 80s that times were so bad that even people who didn't pay their bills weren't buying. I thought it was a great description of what happens in a normal recessionary or deep recessionary period of time. People who don't pay their bills, they don't buy. That's what a recession is. And when you have that coupled with rising prices, um, that's a really difficult time. That's stagflation. Prices increasing, at the same time you have an economy that's falling off. Difficult times, hard to cure, hard to deal with by a central bank. We've been through it in the 1960s and 70s. Other countries have been through it at different periods of time. So,
Mike, thank you, Mike. The next question, do you favor value investing like Warren Buffett, or do you also include technical analysis tools to pick stocks?
my focus is on finding changes in lifestyles, demographics, and technology. Think about the three examples that I gave of stocks that did well in the 1960s, 70s, and into that inflationary period of time. A little chain today, it's not little, but it was a new company. It came public in 1966. It was a restaurant that had no place to sit down, and they sold cheap hamburgers. That was a significant lifestyle change. Think about a company that started in Seattle, that was one of the stocks in our portfolios for a long time. People ask, who would pay $4 for a cup of coffee when you can get a cup of coffee for 50 cents? That was a lifestyle change. It's a lifestyle change that continues today. Think about other lifestyle changes. Think about who would have said in 2005 that people would take a business trip or a pleasure trip. They would fly in somewhere, get into a stranger's car who would drive them to a stranger's house where they would stay. People wouldn't believe that that was true. That was a lifestyle change. Demographics. Look at the changes that are going on in terms of demographics and in technology. It's not value investing. It's finding changes in lifestyles, demographics, and technology. That's what worked. And remember, talking about Buffett gave up in 1972, and Buffett had a very good track record in the 60s going into 70s doing the Graham and Dodd value type stocks. But in 1972, Buffett sent money back to his investors and said, this doesn't work anymore. He went to Columbia and studied there with some of the professors at Columbia and came back with a different investment philosophy, not completely value style. Value figured in and fundamental analysis figured in. But true value investing, Buffett gave it up in 72 and sent money back to his investors. Anyway.
Mike, the next question, and a lot of the questions that have come in, we're going to have the same answer that we give every week, which is, everybody here has a unique situation. You have unique financial needs. You have a unique timeline on your financial needs, and many of these things will require a unique answer for your unique situation. So that's why into the chat I've put Mike's email address. If you want to hop on a non-sales call, this is just an answer to get a call to get straight answers about your unique situation. Just send Mike a quick email, and he's happy to meet with you. But the questions, a couple of the questions are: should I move money out of my 401k or retirement right now? That's one of the questions. Another one: is it better that I pay off my debt or invest when everything costs more?
Depends upon your individual situation. I think what
Yeah.
Chris just said, it depends upon your individual situation. There may be some people that should pay off their debt. For some people, it's a question of quality of life. I've had clients that said they would feel much better. It didn't make financial sense to pay off their debt because they were paying 3 or 4% on their mortgage. Didn't make financial sense because their accounts were growing at significantly greater returns. But it was a quality of life question. And I said, yes, pay off the condo or pay off your house. It'll make you feel safer, more secure if it's all paid off. Use the money for that. And they did do that. And it's a quality of life. Other people, it's better to keep the debt going because you can make more money in the market than you can by paying off the debt.
Mm-hmm.
So it's really an individual question, your personal situation, your personal feeling, your quality of life. It depends upon a lot of non-financial financial questions.
Mike, to put it in simple terms, it's looking at percentages that you're paying compared to the percentages that you have the potential to make, and then making intelligent decisions based on that data.
That's a financial decision, but that's not a quality of life decision. A lot of decisions are quality of life, not financial decisions.
Mm-hmm.
And that depends upon every individual.
Mike, from Dale, I agree that inflation is coming and the value of the dollar will go down. Dale also believes that gold and Bitcoin will increase in value. So transferring funds is slow and expensive. It appears that Bitcoin and blockchain will help lower the cost of transferring funds. This could help boost Bitcoin, and he's interested in your opinion on that situation.
Bitcoin and cryptocurrency, there's no question that blockchain technology is incredible. Blockchain technology is what drives Bitcoin. It has a lot of other applications besides Bitcoin and cryptocurrency. And I know that that's done extremely well, but it has no earnings. It has no basis other than what people are willing to pay for it. I see the same situation with Bitcoin that I saw with dot-coms. When the dot-coms came out, it was a huge potential market for the internet, but a lot of dot-com companies had no income, they had no revenues, and those companies were bankrupt by the end of the year. When the market really turns and things start to go down, what's going to keep up the price of Bitcoin? If you look at a stock, you can look at the company and you can look at the revenues and you can look at the earnings, and maybe the earnings don't grow as fast, or maybe the earnings stabilize, or maybe the earnings even go down, but you have a reason for evaluating that stock, the company. You have a real reason to see that happen. And maybe the PE shrinks because that happens during contraction periods of time. But a Bitcoin has no earnings. It has nothing other than what people are willing to pay for it. It's the same. We talked about the tulip bulbs
Mm-hmm.
a couple times ago. People were willing to give up 12 acres of land for 2 tulip bulbs. What's a tulip bulb worth today? Not 12 acres of land, not 2,000 tons of butter. Bitcoin, a lot of hype, a lot of feeding frenzy over cryptocurrency. But if it turns down, what keeps it going? Reminds me of when you have transactions taking place. For every happy buyer, there's a happy seller. What happens when there's no more buyers? You know, I stay away from cryptocurrency and crypto coins because I'm looking at something which can be valued in terms of fundamental values, that has earnings, that has revenues, or has a credit backing, that has a coupon, that has a maturity date, something that has a financial fundamental reason for owning, other than it's just going up.
It's a great answer. Thank you for that. A couple of people have asked directly in the Q&A if there's going to be a replay of this. Well, we are recording this and we'll be editing down the replay by tomorrow, and we'll be getting it up in a place. So we have an email that will go out with a link for the replay for you. So, yep, totally get it. Somebody explained that that something came up during the presentation and it took their focus away, but they're back. So yeah, we'll be getting that replay right out to you so you can watch this. Mike JJ says, what do you think will happen to the 10-year bond yield under the stagflation scenario?
Double digits. Going back to the last stagflation, it was double digits. No, it did not keep up with inflation, but it did do double digit.
Hmm.
You can buy treasury bonds at 11 or 12 or 13%. I mean, those were really great times. You could buy municipal bonds at rates of 8 or 9%. Seattle City Light, Tacoma City Light bonds, issued originally at 4%, defeased with US Treasuries at 30 and 40 cents on the dollar. The returns on those bonds, when I was doing those bonds and I was buying those bonds for clients in the 1980s, late 80s, early 90s, the returns were like 20 or 25% a year, capital gains on those bonds. It was almost a slam dunk, can't lose type situation. On the other hand, when the bonds were going up, or when interest rates were going up, they were a can't win situation. And I sat next to 2 guys that had been bond brokers for 30 years, part of the bond vigilantes, so-called bond vigilantes. And what they described during the times when bond prices were sinking and values going up, there was a huge tax benefit, because the bond you bought last year, you would sell this year and buy an equivalent bond this year and take the tax loss. And next year, you'd sell the bond you bought this year, buy an equivalent bond and take the tax loss. And the following year, you'd sell the bond you bought the previous year. Anyway, you got a huge tax benefit by doing that. And especially if you could do it in less than a year, so you got short-term tax losses every year to offset the drop in the price of the bonds. But at the same time, you were losing principal every time you made that happen. You had to depend upon the market turning and coming down the other way when you could make really strong profits. And hold the bonds for a little over a year before you sold them, so that you got a long-term tax gain versus short-term when bond rates were going the other way.
Thanks, Mike. You know, for everybody that's here and Mike, everybody that's come today has stayed the entire time. The fact that you're here and that you're at this point in the presentation tells us that you're someone who's conscientious about your investments and you want to make sure that you're doing the right things. And that's why Mike has made himself available for you to give a fresh perspective on your investments. So if you've seen it or not, if you look in the chat, I've included Mike's email address. If you want to just drop him an email, that's directly to him and he responds directly to all emails. And Mike, with that, we have answered all of the questions that have been asked of us today. Would you like to give us a preview for what's coming up next Thursday?
So let me say, right now is one of those times. I think the Fortune article was right on. Most people don't see it. They see that water has risen 2 inches. They don't see the tsunami coming.
Mm-hmm.
Right now, that's the cost of inaction. By the time the tsunami hits, you should have been away from the shore.
Mm-hmm.
Now is the time to prepare. It's a time to look at what you've got and where you're going. Next week.
Mike, why don't you stop the share so we can finish this off on full screen?
Did I stop the share?
Not yet. Still have the presentation up.
Next week, financial planning in a dynamic market.
Oh, yeah.
The best laid plans of mice and men often go awry. Robert Burns wrote that a couple centuries ago. It's still true. Financial planning is built on bad statistical assumptions. It's built on questionable data. It has any number of problems. It's like thinking about flying a plane from Seattle to Hawaii and thinking only about the course corrections you need to make without realizing you don't have enough fuel to make it.
That's awesome.
That's next week. That's where we're headed.
Mike, Jerry asks, what was the publication that had the article that you were talking about?
Fortune magazine.
Fortune magazine, Jerry.
So it's the article that came out today, and I say Fortune magazine, it's online that I got the article. So I don't know if it's in the magazine or not, but it's an online article. You can read it. And if you don't have a subscription to Fortune, I think you can read it on Yahoo or some of the others. I think it'll be published a number of places. So.
Well, let me just say this as we wrap up today. I want to thank everyone for taking the time, Mike, for them taking the time to hang out with you today and listen to your insights. I appreciate all the questions that were asked and the conversations that we had. We'll get the replay out to you as quickly as possible. Mike, I'll hand it over to you to bring us home.
Well, thank you very much for being here. This is a really crucial time. I keep saying it. I will continue to say it. We're coming to a time in which we could be hit with a tsunami. And I hope I'm wrong in saying that. I hope that things just roll along smoothly and the economy does well, the stock market does well, the bond market does well, Bitcoin does well. But I think that the odds line up in a different direction.
Mm-hmm.
And I think that that's important to be aware of. I think that's where we need to be. So anyway, with that, have a very good weekend. And I will be back next Thursday talking about financial planning.
See you then.
Take care.
Bye, everybody.